Welcome to another case study by Blueprint to Escape. Imagine buying into a high-yield fund, right? It does exactly what it promises. It flawlessly executes this complex strategy, mirrors the underlying assets perfectly.
Yeah.
And yet it still loses you over 12% of your capital in just 6 months, all while the broader market is just, well, barely blinking.
It is really the ultimate paradox for an income investor. I mean, when a fund bleeds that much value, your immediate instinct is to just assume the internal machinery is broken. You assume someone at the wheel fell asleep.
Right, which is exactly why we are looking at the Harvest Diversified High Income Shares ETF today. The ticker for this one is HHIS.
Right.
We are digging into an updated case study published in mid-April 2026. This is actually following up on an initial analysis from about 2.5 months ago.
Exactly. Because after an absolutely stellar year in 2025, HHIS really hit a wall.
It did. So the mission of this case study is to answer a very urgent question for you. If you are holding this fund right now, looking at your brokerage app and just seeing red, is the complex machinery of this ETF fundamentally broken? Or is it just a victim of its own underlying market trends?
Yeah, that is the big question.
Okay, let's unpack this.
Yeah.
Because to understand why the engine stalled, we really have to look at the incredibly aggressive way this thing was built in the first place.
We do, because HHIS is not, a standard ETF where a manager simply buys a basket of stocks. It is structurally very unique.
Right, it's a fund of funds.
Exactly. It actually holds 20 underlying single stock covered call ETFs, all managed by Harvest. And the target here is strictly high beta sectors. We are talking major tech companies, data centers, Bitcoin proxies, blockchain firms, and fintech.
Wait, let's pause on the mechanics for a second, because that term, single stock covered call ETF, that sounds like financial word salad to a lot of people.
It really does.
So to visualize this, it's essentially like renting out a house you own, right? You hold a volatile tech stock, and you write a contract, a covered call, basically selling someone else the right to buy that stock if it hits a certain price, and you get paid a premium upfront in cash.
That is the perfect way to look at it. You get cash today. But the trade-off is that if the stock absolutely skyrockets, you have capped your upside.
Right, you missed the moonshot.
Exactly. You don't get to participate in that massive rally past your strike price. And Harvest is running this active covered call strategy on up to 50% of the entire portfolio.
Okay, so they are essentially trading away half of their potential moonshot gains in exchange for a massive, predictable stream of monthly cash, which, on its own is a fairly standard income strategy.
It is, but Harvest didn't stop there.
No, they didn't. They decided that cash stream wasn't quite high enough, so they pushed the risk dial further by applying 25% leverage across the fund.
Right. They're literally borrowing money to buy more of these volatile assets just to juice the yield even higher. So when you combine high beta tech and crypto assets, a 50% covered call overlay, and 25% leverage, you're constructing an engine designed to run incredibly hot.
It really feels like taking a car that's already driving on black ice and strapping a supercharger onto it. Sure, it amplifies your speed, but the moment you lose traction, the spin out is going to be exponentially worse.
Absolutely.
But, we have to give them credit where it's due. For the entirety of 2025, that car was winning every single race. The data from the case study is just staggering.
Oh, the 2025 honeymoon period.
Exactly. From its launch in January 2025 through October of that same year, HHIS posted a cumulative price return of over 24%.
And remember, that is just the capital appreciation. On top of that, it paid out roughly $2.26 per unit in monthly dividends over that 10-month window.
So if you factored in the reinvestment of those distributions, you were looking at a total return hovering near 30% in less than a year.
Yeah, which is massive.
So naturally, investors flooded into this thing. It blew past $1.2 billion in assets under management in a very crowded market, and it actually sits at nearly $1.4 billion today in April 2026.
It's a huge fund.
But here is the challenge I have to throw at this strategy. If you build an engine that runs this hot, isn't a structural breakdown inevitable when the road gets bumpy?
Well, answering that challenge brings us directly to the 6-month skid.
Okay.
Because from late October 2025 through early April 2026, the road did get bumpy, but the broader market didn't collapse.
Right.
If we look at the tech-heavy NASDAQ over that exact 6-month window, which is represented by the XQQ ETF, It experienced a very mild decline. It was down just over 1%.
Barely a scratch. I mean, that's basically a totally flat market.
A completely flat market. Yet during that exact same time frame, HHIS plummeted by over 12%.
Wait, so the Nasdaq barely blinks, our ETF drops 12%, but
Yeah.
you're telling me the structure isn't broken? How does that math work for the investor looking at their portfolio?
What's fascinating here is that the numbers prove the exact opposite of a breakdown.
Wait, really?
Yeah. The case study confirms there is no internal structural failure. The management team is operating strictly by the mandate, and more importantly, there is no hidden yield trap causing the net asset value to erode from the inside out.
We should probably define that for anyone wondering what a yield trap looks like. A yield trap is, when a fund pays out an incredibly high dividend, but they aren't actually generating that cash from profits or options premiums.
Right. They are literally just giving you your own capital back.
Exactly. Just to maintain the illusion of a high yield, which quietly destroys the underlying value of the fund over time.
And that is a very common failure point in complex derivative funds, but it is definitively not happening here. The options strategy is functioning perfectly. They are generating real premium.
Okay, so if they are generating real premium and the broader tech market is basically flat, how do we explain a 12% cratering in the fund's value?
Well, we have to open up the hood and look at the exact 20 holdings detailed in the case study. Because when you isolate the assets, you realize HHIS is actually two entirely different portfolios living inside a single ticker symbol.
Like a tug of war.
Exactly. Let's look at the top half first. The top 7 components make up 51% of the fund's total weight. And these are your mega cap tech giants.
And the case study highlights that these top components are actually thriving. For example, Google, or Alphabet's single stock ETF, ticker GOGY, boasts a 31% 6-month return.
Yeah, that's huge.
Right. And Broadcom, ABGY, is up over 7%. Eli Lilly, LLHE, is up over 14%.
Right.
So more than half the fund is doing exactly what it's supposed to do.
The issue lies in the lowest weighted components. They are the heavy anchors dragging the whole fund down exponentially.
But what are those anchors?
In late 2025, the fund managers added several highly volatile fintech and blockchain assets. And over the last 6 months, those specific sectors got absolutely slaughtered.
Yeah, the case study lays out the carnage, and it is brutal. These bottom feeders, like Circle, CRCY, down over 56%. Coinbase, CONY, down 51%. Robinhood, HODY, down almost 58%.
It is a massive drag.
But wait, this forces a psychological question here. Why would Harvest add these hyper-volatile assets in the first place when they already had stable giants like Google and Broadcom?
It all comes down to the mechanics of chasing yield. When the broader tech market stabilizes, the implied volatility drops.
Okay.
And options premiums are heavily dependent on volatility. The wilder a stock swings, the more cash an options trader will pay you to take on that risk.
Ah, I see. So to maintain that flashy 28% total return from earlier in the year, they couldn't just rely on stable tech stocks anymore. They had to reach further down the risk ladder into crypto and fintech just to find the volatility needed to harvest those massive premiums.
Precisely. They bought extreme volatility to sustain the yield. And the worst offender in that basket was a holding called Strategy, formerly MicroStrategy.
Oh yeah, ticker MSTE.
Right. The case study describes this as a piece of complex financial engineering. It's a leveraged corporate play on Bitcoin.
And then HHIS adds its own 25% leverage on top of that. That is wild.
It is leverage on top of leverage built on a historically volatile asset. And the result, it tanked a devastating 65% in 6 months.
It's like baking a beautiful, stable cake with premium ingredients like Apple and Amazon, but then deciding to throw a handful of ghost peppers into the batter at the very end.
Yeah.
The oven isn't broken, but the cake is still going to burn your mouth.
That is a great analogy, and the case study actually proves that your oven analogy is mechanically sound.
Oh, really? How so?
They ran a diagnostic check because they wanted to see if the single stock ETFs were properly tracking the actual underlying stocks.
Oh, I see. Because if the mechanism was flawed, like if MicroStrategy stock only dropped 10%, but the ETF dropped 65%, then you'd know it was broken.
Exactly. Then you would know the covered call strategy and the leverage were cannibalizing the fund. But the data shows they mirror each other almost perfectly.
Yeah, the underlying Google stock was up about 30%, and the Google ETF was up 31%.
Right. And on the downside, the underlying MicroStrategy stock plunged 61%, while the corresponding ETF plunged 65%.
So that slight 4% difference is really simply the natural cost of leverage and options mechanics in a severe downturn.
Exactly. The ETF mechanism is flawless. The raw ingredients are just highly volatile.
So if the math proves the ETF is doing exactly what it promised, the real problem isn't the engineering, it's the ingredients. Which pivots us to what this actually means for you, the listener. How do you handle a fund that is mechanically flawless but practically bleeding your capital?
Well, you look for the silver lining of that exact mechanical design. Because despite the severe drop in capital value over the last 6 months, the monthly yield of HHIS actually increased this year to 27 cents per unit.
Which initially sounds totally counterintuitive. I mean, my capital drops 12%, but my monthly paycheck goes up.
Right, but based on what we just discussed about implied volatility, it makes perfect sense. It's due to the massive options premiums generated by all this volatility.
So the ghost peppers are actually paying off.
They are. The extreme volatility in the crypto and fintech sectors that destroyed the underlying capital value was simultaneously generating massive options premiums. The managers harvested the exact volatility that was sinking the ship to increase the monthly distribution.
The wild swings that kill the capital generate the premium. That is a fascinating, almost toxic symbiotic relationship.
It really is.
So what is the action plan here? What is the case study's actual stance on how to navigate this?
The stance is highly disciplined. They are not selling their positions in a panic, but they are entirely halting any new lump sum buys.
So they are just holding the line with standard dollar cost averaging and letting the dividends reinvest for now.
Yes. They are waiting for a clear, sustained change in momentum, basically waiting for positive momentum in tech and crypto before committing larger capital. The heavy anchors have to start dropping before you start adding weight to the ship.
That makes sense. But the case study also throws a brilliant pitch over to the fund managers at Harvest, which I love. They suggest creating a spin-off. Let's call it HHIS Light, or maybe HHIS7.
A purified version of the portfolio.
Exactly. Build an ETF containing only the top 7 to 10 mega-cap tech giants. Keep the 50% covered calls, keep the leverage, but completely strip out the hyper-volatile blockchain and fintech anchors. Take the ghost peppers out of the recipe and let investors buy the stable cake.
If we connect this to the bigger picture, this teaches us a really important lesson about all-in-one income solutions.
What's that?
You cannot simply look at the top-line yield. You have to fundamentally understand the beta, the volatility, and risk of the underlying assets.
Right, because an 8% yield generated from a stable utility company is a fundamentally different financial instrument than an 8% yield generated from a leveraged Bitcoin derivative.
Exactly. And when a fund manager packages them together, you are inherently accepting the volatility of the absolute riskiest asset in that basket. This case study mathematically proves that even if half your portfolio is anchored in the most profitable companies on Earth, a tiny 5 to 10% allocation to extreme volatility will drag the entire ship down during a sector correction.
Which ties it all back to you. If you hold a high-yield fund, a covered call ETF, or any bundled income product, do you actually know what is under the hood? Have you audited the bottom 10% of the holdings? Because it is very easy to ignore the fine print when the yield is high, but you need to know exactly what ghost peppers might be hiding in your portfolio's bottom percentiles.
It is an audit every investor should perform. But, as always, per the case study's strict instructions, we must remind you that this analysis is strictly for educational and entertainment purposes only. It is not financial, tax, or investment advice. You must always do your own thorough research, speak to a licensed professional, and remember that no companies or ETFs mentioned are official sponsors.
Exactly. And we want to hear how you are handling this market. Please post your comments or questions below. Let us know your favorite income strategy, and make sure to subscribe for more content about financial independence, passive income, early retirement, and nomadic life design.
And as we wrap up, I want to leave you with one final puzzle to chew on regarding that proposed HHIS Light ETF.
Okay, let's hear it.
If Harvest actually takes the advice to create an HHIS Light that completely strips out all the highly volatile crypto and fintech stocks to protect your capital, would the remaining safe tech stocks generate enough options premium to sustain the massive high yield you wanted in the first place?
Oh, wow.
Right. Is it possible that the severe volatility you hate when your capital drops is exactly what's paying your dividends?
You might not be able to have your cake and eat it, too.